What is going on, YouTube? I'm Mike with Penner Investments, and today I'm going to talk about my trades on Netflix. Be sure to hit the like button, share this video so others may learn, and subscribe to my channel so you do not miss out on future content. Let's dive in. Netflix just had their earnings reported the other week and they crushed it. The great thing about the stock market is that rationality does not always prevail, but instead fear and greed do. As options traders, this makes it easier for us to take advantage of this and profit. When a company has a poor earnings, it usually drops down lower than it should be, like Tesla did just this past week as well. When a company crushes earnings expectations, as Netflix did, it usually runs up a little too quick, and this is followed by a pullback from a little bit of profit taken as well. Remember, my rule to enter a put credit spread and sell naked puts is a 2% or greater pullback on the stock. This is where I jumped in on Netflix and sold a put credit spread the other day, and I selected the 510 and 505 strikes, and I went out my typical 45 days to expiration. This gave me a $636 credit. I selected the 510 strike from the 15% delta on the options chain. This means it has a 15% chance of expiring in the money. That means I have an 85% chance of that trade winning if I hold it to expiration. I like this trade because I'm bullish on Netflix, and the stock would have to have a 10% further pullback to put this trade in jeopardy of being a losing trade. I like to do these credit spreads on very high probabilities of winning, and since the company just reported earnings, I will not have this trade on during their next report date. As I like the stock and would not mind owning 100 shares, I also did a naked put on this stock. For this trade, I went out 30 days, as I always do for naked puts, and selected my strike price of $545 by seeking the 2% premium. This means I multiply the strike, 545, by 2%. Then we multiply by 100, since all options are dealing with 100 shares. This would put me somewhere around seeking a $1,090 credit for this trade to be worthwhile. I went with the closer strike to get this credit, which was a $940 credit. This is a big credit, but keep in mind if it's signed 100 shares, this will cost $54,500 to buy 100 shares of the stock. These are a couple of the main strategies that I do each week. I do put credit spreads and sell puts as part of the wheel strategy. Then once it's signed, I do covered calls, and then I like to do put credit spreads on top of these. From all of my years of options trading, I've found that the wheel strategy to be the most profitable, with put credit spreads is a strong second. As always, if there's ever anything you'd like me to discuss further, drop a comment in the box below. Thanks for watching, and good luck trading, guys.